is the Legal and Financial Accounting Service, PLLC, Introduction to Financial Accounting Group Project. It's presented by Bryant, Blanchard, Brian Dupuy, Layne Mcallister, and Carey Hedman.
Okay, we're going to start this off with revenue. Well, what is revenue, you might ask? Revenue is the amounts earned from sales of products and other sales. The different types of revenues are sales revenue, service revenue, and interest revenue. Sales revenue is the revenue that is earned by the sales of goods. Service revenue is revenue that is earned by the sales of services. Interest revenue is revenue that is earned by debts that a firm owns. Here we have examples of revenue on an income statement. This specific firm includes sales revenue and service revenue on its income statement, where this firm sold products and goods. Next, we have expenses. Expenses are the total cost of assets consumed or services used. Some examples of expenses are equipment, employee salaries, buildings, utilities, and marketing costs. Keeping track of expenses is important to a business because it can help keep track of how much a business has spent. It can help find ways to reduce spending, and it is used to calculate a business's profit, which is the revenue subtracted the expenses. And here's an example of expenses on an income statement. The business spent money on salaries for the employees, rent for the facility, utilities, marketing costs, insurance, and taxes. Next up is current assets. Current assets that a company intends to convert to cash or use within 1 year or the current operating cycle, whichever one comes first. And current assets, they're listed on a balance sheet in the order of liquidity, which is the order in which the company expects to convert the asset into cash. Examples of current assets. It's listed in the order of liquidity. First in that order is cash, which is payment for goods and services. Next up is investments. And then after that is receivables. Receivables are self-explanatory. It's what the firm or company receives from customers. Accounts receivables is accounts customers owe on, which results from the sale of goods and services collected within 30 to 60 days. Notes receivables is written promises for amounts to be received. Associated interest rate, which typically extends for 60 to 90 days. Interest receivables is the accounts where interest is due to the company. Then after receivables, it's inventories, which is finished goods, works in progress, and raw materials used in manufacturing. And then finally on the order of liquidity, it's prepaid expenses, which comes in the form of insurance and supplies. Current assets are important when evaluating a company's short-term financial strength. Understanding your current assets allows companies to analyze their financial ratios between their assets and liabilities, called liquidity ratios. Current ratio is the current assets over the current liabilities. These assist companies in determining whether they can meet their short-term obligations and is a dependable indicator of a company's liquidity. Next up is the debt to assets ratio, which equals the total liabilities over the total assets, and is a measure of solvency for the company. And current assets on a balance sheet, it should be the first items listed under your assets group. You should always list your current assets in order of liquidity, which is cash, accounts receivable, notes receivable, inventory, supplies, and then prepaid insurance. Total current assets should appear at the bottom of this subsection. Total current assets plus long-term investments plus property, plant, and equipment plus intangible assets equals total assets.
All right, next up we have long-term assets. So what are long-term assets? It's defined as assets that will have a useful life for more than a year. Typically, these assets will appear on a balance sheet for many years and they carry less liquidity than a company's current assets. So they usually fall into three main categories. It's going to be long-term investments, property, plant, and equipment. And then the third one is intangible assets. Long-term investments, these are going to be stocks and bonds of other corporations that are held for more than a year. It's important to note that long-term investments should not include assets that are used in the day-to-day operations of a business. Next is property, plant, and equipment. These are also known as fixed assets. They can include land, buildings, cars, machineries, and even computers. When you account for fixed assets, you have to factor in depreciation, and we're going to talk about that next. So depreciation is defined as the allocation of the cost of an asset over a number of years. This is done by assigning a portion of an asset's cost as an expense each year. There are three main factors used to compute depreciation. The first is cost. You have to establish the cost. Typically, that's going to be what you paid for. Like, say, take like a van or a car used in business. You're going to pay a certain amount for that when you purchase it. Then you have to establish the useful life. That's always done using estimates. You know, how long do you think it's going to last? How long are you going to use that car? Or is it going to be a daily commute? Is it like a once in a week type of thing? You have to take into account like the repair and maintenance schedules. And the next is going to be your salvage value. So how much do you expect that vehicle to be worth at the end of its useful life? So it's typically calculated using one of three methods, straight line, declining balance, or units of activity. Since 95% of corporations in America use the straight line method, that's what we're going to talk about. So the straight line depreciation method, using this method, companies expense an equal amount of depreciation each year over the asset's useful life. So if you take, for example, say they bought that car at $13,000, and then they determined that the useful life is 5 years. And then they determined that at the end of that useful life, they expect it to still be worth $1,000. So your depreciable cost is $12,000. For $12,000 over 5 years, that's going to end up being $2,400 a year. And if you see on the bottom, that's how it would be journalized on a balance sheet. So the next long-term asset is intangible assets. These are simply non-physical assets, things like trademarks, copyrights, domains, and things of that nature. So why these are important to account for? Businesses account for their long-term assets to create a more accurate financial reports and evaluate the business ventures as a whole. And it gives the corporations a better sense of how to look into the future. All right, on the right, you can see how this should look on a balance sheet. As you can see, these are all going to be listed under your assets portion of the balance sheet. First, going to have investments. You have your fixed assets. Then last will be intangible assets. And like all sections, you put your numbers in and then you account for them. Your total is going to be at the bottom on the right. All right, so we're going to talk about liabilities now. Liabilities are defined as the amounts owed to creditors in the form of debts and other obligations. They typically fall into two categories known as short-term liabilities and long-term liabilities. So we're going to talk about them individually now. First up is short-term liabilities. These are also called current liabilities, defined as creditors' claims on total assets and existing debts and obligations. Companies must settle these debts or obligations typically within the current operating cycle, and that's either done by transferring assets, whether it be cash or some other type of asset, or the transfer of goods and services. Some examples that you're going to find on your balance sheet: accounts payable. These are used to account for items bought typically in large amounts on credit, and they relate to like day-to-day operations. They're always going to be listed on our accounts payable. Things like cost of raw materials, fuel to go with your vehicles, travel expenses, and equipment. Next, you're going to see notes payable. These are used to record obligations that you owe to other firms. Often used instead of accounts payables because they give the lender formal proof of the obligation, and they typically require the company to pay an interest amount. Next, you have unearned revenues. These are best described as goods or services that have not been provided, but the company has already received the advance payment for that. Great examples are season tickets for sporting events, as well as pre-booked airline tickets. So once the payment is received in advance for a goods or service, you should debit cash and credit current liability account for the source of the unearned revenue. Once that revenue has been fulfilled, you should debit the unearned revenue account and credit the corresponding revenue account so it balances out. Last, you're going to have accrued liabilities. These are things like taxes you pay on income, corporate income taxes, payroll taxes such as like federal and state unemployment, and your salaries and wages. All right, so this is how short-term liabilities should look on your balance sheet. Very, similar to the other sections. Current liabilities is going to fall under the liabilities and stockholders equity main group. And again, they're listed notes payable, accounts payable, unearned sales revenue, and you have your total at the bottom. So why are these important? Understanding your short-term liabilities are useful when determining a company's overall short-term financial position and can be used to develop and adjust business strategies. Short-term liabilities can affect everything from a company's profitability to its liquidity. Next up, we have long-term liabilities. These are obligations that a company is expected to pay after 1 year or the established operating cycle. Some examples we have are bonds payable. These are simply like a legal agreement for like an IOU that one firm would issue to another company or firm. They're typically always paid back in predetermined increments with interest. Next, you have mortgage payables, which is, simply like if you finance a building to run your operation out of, you have to pay, your mortgage every month. And those are interest rates are usually fixed or adjustable depending on the agreement. Next, you have long-term notes payable. They're similar to bonds. These are typically used to account for long-term loans used to finance business operations and ventures. Lease liabilities, very similar to mortgages, used to account for long-term lease payments, used to acquire land, buildings, or equipment temporarily. Last, you have pension liabilities. These are used to account for long-term liabilities associated with retirement benefits for retired workers and retirement payouts. All right, so this is how it's going to look on your balance sheet. Very similar. You have the main long-term liabilities, and you have bonds payable. In this particular example, they actually deducted the discount on bonds payable, so that's why it goes from $1 million to $920. And same as the other ones, your total goes at the bottom. So why are these important? Like short-term liabilities, understanding your long-term liabilities is useful when determining a company's long-term financial standing and can be used to develop and adjust business strategies.
All right, now we're going to talk about equity. So equity is the value that would be returned to a company's shareholders if all the assets were liquidated and all the company's debts were paid off. So here's a few basic examples of equities to get the idea. So there's $25,000 car and you owe $10,000, so the car will represent $15,000 in equity. And then if you have a $400,000 home, you have a $150,000 mortgage on it, you'll have $250,000 in equity, and I'll go over it on the balance sheet in a couple slides. So it's important because it helps specifically when you're dealing with a company. So shareholders know what their return is gonna be on an investment. So another basic example of company A brings in $100,000. Let's say, Brad's purchased a 20% of that company for the stocks, and he would get $20,000 on dividends. And so it helps people figure out what they'll receive in certain situations. And then, so on the balance sheet, equity is the total assets minus the total liabilities. I put a picture in there just now, but basically on the balance sheet, you have all your assets grouped up, and then the total of it underneath, and then your liabilities and the total of it underneath, and you just subtract the assets. No, you subtract the liabilities from the assets to get your equity. And then next for income statements, it's a financial statement that shows how much income a company generated after expenses. So you have your revenue minus your expenses to get your net income. And they are important because it allows us to see how much money you've made, not just how much money you brought in, but how much profit you've gotten. And the net income produced from the income statements then allows you to figure out your retained earnings. And then from your retained earnings, you can produce a balance sheet. So it all flows together. And then here's a picture of an income statement. So as you can see, you have the revenue up top, and then you subtract all your expenses and your losses, whatever they may be. And then you subtract your taxes from it. And so it's kind of an expense. But then once you get that, all of your expenses and taxes out of the way, then you see how much money you made in profit.
Okay, so next we're going to talk about retained earnings. The retained earnings are the amount of net income that's left over for a business after it's paid out its dividends to shareholders. And the excess earnings can either be distributed amongst shareholders or retained, which is why they are called retained earnings. And corporations use these earnings for several things, including hiring additional workers, investing in new technologies, or upgrading infrastructure. So retained earnings are important because they are a crucial component when calculating a company's financial well-being, and they also establish the net income that a company has accumulated over the operating cycle. This allows companies to make important decisions like whether to reinvest in the business or distribute to shareholders. So to calculate retained earnings, you will add the current retained earnings plus net income subtracted by dividends, which will give you the retained earnings for the semester or for the quarter. So we have examples on the balance sheet, how it will look like. So it'll go in like liabilities, stockholders' equity. Go do the common stock, retained earnings to get the total liabilities and stockholders' equity. And then next we're going to go into the correct order of financial statements. There are 3 financial statements: the income statement, the retained earnings statement, and the balance sheet. All of these are important and are in a specific order. The income statement is used to report your income and expenses, which illustrates how successful or not successful a business is and has been performed over a certain period. The retained earnings statement indicates the amount of income from your previous operating cycle that was paid out in dividends and how much was retained for future business growth. And the balance sheet is used to show what assets
Okay, I think she's having some technical difficulties, so I will pick up for her. The balance sheet is used to show what assets and what liabilities your business has at a specific point during your operating cycle. Why is it important for the statement to be in this order? These statements build off one another, beginning with your income statement. Your monthly income statements establish whether a business has a net income or loss for that month. Your net income is then factored into a retained earnings statement where dividends are deducted. This gives you your total retained earnings for the month, which are then reflected on your monthly balance sheet. Without first correctly establishing your monthly income, you cannot determine accurate monthly retained earnings. These items are included in your monthly balance sheet, so if your accounts are incorrect, beginning with your income statement, it will reflect in the remaining balance sheet. Monthly balance sheets are then compiled into yearly balance sheets at the end of the operating cycle. Therefore, if even one of your monthly balance sheets are incorrect, your yearly balance sheet will be incorrect. Without accurate accounting, businesses cannot make informed decisions about their future. And this is an example of all three for the order of the income statement, the retained earnings statement, and then the balance sheet. You can see the net income on the first one, it's $28.60. And then for the retained earnings statement, you take the net income and you subtract the dividends, which is $500, and that'll equal your retained earnings of $2,360. And then that $2,360 from the retained earnings statement is included on the balance sheet under stockholders' equity, which brings the total up to $12,360. And thank you so much. And we want you to join our company. And this should give you the refresher that you need.